Some of the biggest gains that you have ever seen are coming from this one investment strategy, the almighty leaps option. If you watch this entire video, you will know exactly how you can make insane amounts of money with leaps and how this investment strategy literally has a 0% fail rate. So no more wasting time, let's get right into the in-depth guide to the leaps strategy. So the first question that most likely comes to mind: what are leaps? Well, the word leaps is actually just an acronym that stands for the term long-term equity anticipation securities. Now, I know that sounds like a whole bunch of jumbled up words mixed together, so that's why we call them leaps. Leaps are an option strategy that consists of buying super in-the-money contracts at a very far out expiration date. Usually these expiration dates are anywhere from 8 months to around 2 years. And without a doubt, these are the easiest, least risky, and most effective way to trade options and actually make money in the stock market in 2022. Now, I know what you may be thinking. You haven't said anything about how they're actually profitable yet. So I got you, don't worry. There's a few reasons that leaps contracts are so profitable and allow you to make stupid amounts of money in the stock market. Buying leaps contracts are significantly cheaper than buying 100 shares of a stock. Let's take the stock AMD for example. So what we're looking at here is a $70 leaps call that costs you around $48.80 per share, or about $4,880 in total. Now, I know that this specific contract is a little bit pricey, but let me tell you why. If you click on this $70 call contract and you look down at the bottom, you should see something called the Greeks. Now, I've actually already explained all of these numbers in full detail on my ultimate guide to investing in options video. I'm actually gonna put the link to that video in the description, so if you guys make it to the end of this video and you still have a question about delta or theta, be sure to drop a comment and go check out that video. I try to respond to literally every single comment I get, whether it's about options, investing, the stock market, or even that you just like the video. Now, back to the Greeks. You're gonna see a value called delta here. It's the first value that you see, and it is 0.8705. What we're gonna do is we're gonna drop the last two numbers off of that, so it's gonna be 0.87. What this means is that every single dollar that AMD makes, you are going to make $87 on this contract. So your delta is the main reason that this contract costs more than an out-of-the-money contract. Let's put it into perspective. So the value of your delta if you buy one share of a stock is going to be 1.0. So the closer you can get your delta value to 1.0, the more accurate you are to owning 100 shares of the stock. So we'll go back to our $70 call on AMD. For $4,880, we will have a delta of 0.87, which means that every dollar that AMD goes up, we will make $87 back on that contract, which means that you are replicating owning 87 shares of AMD. So the question is, how much would it cost to own 87 shares of AMD outright? $9,778. So you're spending almost $10,000 to have 87 shares of AMD when you can have one leaps contract for an entire year and have the exact same amount of shares for half the price. And the crazy thing is, the closer you can get that value to 1, the more money you're gonna make from that contract. So let's make up a fake trading card game company called Pokemo. Pokemo is currently trading at $25 per share right now. You can buy one super far in the money contract for Pokemo that has a 0.99 delta for $1,200. So every dollar that Pokemo goes up, we will make $99 on that contract. How much money is it gonna cost to buy 99 shares of Pokemo? $2,400. $2,400. There is literally no reason to not be investing in leaps. The only risk that leaps have is, yes, you can make $95 if you have a 0.95 delta, but you can also lose $95 if the stock goes down $1. So you have to be able to stomach a $100 loss every now and then. But if you own 100 shares of a stock and the price goes down by $1, yes, you're gonna lose $100. So in the grand scheme of things, owning a leaps contract is so much more beneficial than just owning shares of a stock. Well, Sean, slow down. Isn't this contract gonna expire in 1 year? Why would I wanna have that when I wanna have the stock for 5 whole years? Here's the thing, it is so easy to sell your leaps contract when you get towards the end of your expiration date and just buy a new one for a later time. This is called rolling your contracts. So you can just keep rolling your contracts over and over and have the same amount of shares that you would have if you own the stock for half the price. This is a literal unbeatable strategy. And what's crazy about it is that it is so much safer than buying a short-term option. Yes, short-term options are gonna be significantly cheaper. Here's the thing. Short-term options contracts usually fail, and 90% of traders that try to YOLO short-term options only will lose all of their money. If we take a look back at AMD and we change our expiration date to this week, yes, a call at the money will be significantly cheaper. It'll be $4.58 per share, or $458 in total, and you can make so much money off of this. However, here's the thing. You will have a 0.52 delta on this contract, which means you will be making $52 per dollar increase on the stock. That sounds good and all, but since we're so close to the expiration date, we're gonna have to factor in something called theta. This is another Greek, and if we take a look at the Greeks, you'll see delta, gamma, and then theta. Theta right now has a negative 0.3285. So what we're gonna do is drop the last two again, and that means that you're gonna have a negative 0.32 value for your theta. Now what this means is that every single day you have this contract, you are going to be losing $32. So if you have this contract for a week, it's already gonna be worth half of the price you originally bought it for. So if we go back to our Leaps contract, we'll see that our theta is actually 0.02. which means that we're only losing $2 per day on this contract. The reason why is because another name for theta is time decay. And what this means is that every single day your contract gets closer to expiration, theta is gonna start to ramp up. So when it comes to expiration day, your theta is gonna be so much higher than it is 1 or 2 years out. So with this contract, you can own it for so long without having any real effects of time decay all the way up until expiration day. Whereas if you're buying short-term options, you have little to no time, and time decay has already eaten up so much of the contract. So when it comes time to expiration, you're losing so much more money on that contract. This is why most options traders fail, is because they try YOLOing all of their money on super close expiration date contracts that have very low delta and a very high theta, which means that you're not making as much money, and time decay is eating more money as you get closer to expiration. With Leaps, that's not the case. The further out you go, the less theta you're gonna have, and the higher delta you're gonna have, the more in the money you go. So with Leaps, you're maximizing the amount of profit you can make and minimizing the amount of time decay that happens along the way. And you're still doing this for half the price of owning 100 shares of a stock. All right, you know about Leaps. You wanna buy them because you wanna make money. Let me show you how. So we're on my Robinhood account, and we're gonna use AMD for example, just to keep the whole video linear. If we hit trade and go to trade options, our Leaps are gonna be super far expiration dates. So we're gonna try to at least go a year out. So we're gonna try to find around February 18th. So the closest we can find is probably January. That's completely fine as long as it's a very far expiration date. So we're gonna try to find a very, very far in the money contract that has a very low theta and a very high delta at the same time. I picked the $70 call from earlier that we're talking about, and it cost around $4,800 per contract. So click on that, you'll see the Greeks down there again. So just to recap, we're gonna make $87 every single time that this goes up by $1, which also means we're gonna lose $87 every time it goes down by $1. But our theta is super low, so we have really no shot of being beaten by time in this scenario. So this contract is gonna give you the right for 100 shares. And as you see right here, for your limit price, you're gonna see something called bid ask. So your bid is $46.80, and the ask is $50.80. So the bid is the lowest amount of money that people are offering to buy this contract for, whereas the ask is what the sellers are asking for. So obviously, if you want to get your order filled out faster, you're going to want to type a higher limit price. So something closer to $50. But if you really don't want to do that because you just want to get your order filled out and not have to spend an extra couple $100s, then go with the lower asking price. So once we see our max cost, it's going to be $4,800. We're going to hit review and swipe up. Now, I can't really do that because I don't have any money pending to order anything right now. All of my money's already tied up. All right, you've got your Leaps, you're making money, you're balling out, and you want to buy a Lambo. How am I going to sell this thing? So my piece of advice is you do not want to wait until this contract expires. If you let the contract expire worthless, you will not make any money on this contract, and in fact, you're going to lose all of your money. Do not wait until the day of expiration for you to sell these contracts. In 1 year's time, you are not going to be losing money on your Leaps contract, and let me tell you why. The stock market is currently in shambles, and in 1 year's time, stocks like Microsoft, AMD, Nvidia, Apple, all of these stocks are gonna be at all-time highs again. So if you get a little close to your expiration and you see that theta is starting to increase, go ahead and sell your contract. And I actually got a comment on my last video that says something along the lines of, Aren't you gonna get stuck since the contract is a whole year out? You're not gonna be able to sell this contract to anyone. What if you just get stuck and you lose all your money? Well, if you're buying leaps contracts for a company like AMD or Apple or Netflix, these companies that have, trillion-dollar market caps, there are constantly going to be hedge funds and bot traders that are always trying to squeeze every little penny of profit out of you, so there will always be people buying these contracts. The problem comes for when we're trying to trade options like penny stocks. What I would say is be careful, because if you're buying these contracts for companies that have very, very low volatility, very low volume, they're very small companies with very little market caps, you're probably gonna have a harder time finding someone to buy that contract for you. There are actual investment strategies within leaps that make you even more money. One that comes to mind is called the poor man's covered call. So a normal covered call, you would have to have 100 shares of a stock already purchased. So let's say AMD is trading at $120 per share. That means you would already have to have $12,000 invested into this stock. Do you remember that short-term AMD call from earlier that was $400 for the contract? With a covered call, you were going to sell this contract to a buyer. And since you already have 100 shares, you're using your 100 shares as collateral. So if the share price meets the strike price that you're selling your contracts at, you have to sell your contracts at that strike price, no matter what. Now, with a PMCC or a poor man's covered call, you don't even have 100 shares. You have 100 simulated shares because of your leaps. And you can still sell covered calls against these contracts if you're using something like Robinhood. So what you're gonna do is try to sell a call that is so far out of the money that there's literally no way the share price is ever gonna touch it. So let's say that you pick a contract that is $31 out of the money, and that contract is worth $2.15. If the expiration date is 1 week on that contract and your share price doesn't go up $31, which if it does, that's insane, honestly. But if it doesn't, that means that you're just gonna receive that premium that the buyer paid for that contract. If your share price meets your strike price on a poor man covered call, you are gonna be forced to sell your leaps and whatever intrinsic value that you had on that contract. If you don't know what intrinsic value means, at the end of this video, go ahead and click on the video that's gonna pop up on the screen. It's gonna take you to my ultimate guide to investing in options. It's a great video, check it out, it's amazing. So yeah, that's basically the poor man's covered call or PMCC method that you can use to make money while having leaps at the same time. So in conclusion, all hail leaps contracts. Thank you so much for watching, guys. If you enjoyed, please leave a like and comment your favorite stock down below, but subscribe to me. I need all the support I can possibly get on this channel. I'll see you guys in the next one. Later.